All right, good evening, Stonebridge clients. It's Taylor here. Hope you're having a great start to the summer and that you're enjoying time spent outside with family, friends, etc. We got to enjoy it while we have it here. First, want to thank everyone for the patience and understanding over the last month or so with some of the back office changes and the partnership changes we've made recently. We're excited about the future and what this entails, but understand that it's been a bit of a disruption. So just wanted to make sure that we say thank you, for your patience there. It's been great seeing a lot of you recently at some of the events we've had in our new office here. Forgive me for my white walls behind me. I haven't quite moved in. I think I'm the last person to get their office settled, but I'm not in a prison. I am in our office, but it's been great seeing you, and we're happy to be in our new home. So switching gears here, wanting to kind of talk about the markets per usual that we do every quarter. But I'm going to sound like a broken record here, but inflation continues to rule the day. We started to see a little bit of a slowing of the progress on inflation in Q1. The good news is in the last quarter, we did see some progress again being made, albeit slowly, right? The reality is it's a lot harder to get from 3% inflation rate to a 2% inflation rate than it is getting from 6% to 3%, which we saw over the last year or so. So good news is we're still making progress, albeit slow. And we're starting to see the Federal Reserve become a little bit more dovish in their language with interest rates, which is exciting. Another reason for that is the labor market is starting to get a little bit healthier. It's a bit backwards given the fact that a higher unemployment rate is actually leading to a bit healthier of a labor market, but it is true. Having unemployment at historic lows in the mid 3% has been really difficult, especially in the fight against inflation, right? When there at one point was 2 job openings per unemployed person available, that creates a lot of wage pressure. It creates pressure for companies to pay up for more employees and to compete for those employees, therefore kind of negating any sort of progress we can make on inflation. So we're now seeing that ratio at about 1.2 versus 2 to 1, which is much healthier, as well as seeing unemployment up to about 4.1%. As opposed to the 3.5s. This has led to a lot of the dovish language of the Fed, given the fact that they have a two-pronged mandate of making sure inflation is under control and trying to maximize full employment within reason. And so all signs point to a rate cut in September. It's certainly what the market has been pricing in, and it's our base case as well. Speaking of the equity markets, the second quarter continued the bull market in equities. Particularly in the large tech space, right? And even more so in the companies that are, quote, pioneering the artificial intelligence movement. I think there's been a lot of rhetoric. There's been some prognosticators in the media talking about how this resembles March of 2000 with the tech bubble. And while I think it's fair to say equity valuations in the large tech space are starting to get a little bit stretched, it certainly does not have the same flavor that we saw back in March of 2000. We're still 25% below, those valuations on a forward PE standpoint, as we saw back in 2000. Frankly, these companies are generating profits at record numbers. They're growing consistently quarter over quarter, which is pretty remarkable. And they just have better management teams, better structure, higher regulation, frankly, as well. So while it's fair to say that things are getting a bit stretched, we certainly don't anticipate us revisiting what happened in March of 2000. But it's something we're monitoring and making sure we're not getting too overexposed in portfolios, in the tech space. The election, everyone's favorite topic right now, certainly my favorite thing to think about, if you can sense my sarcasm. But
Thank you for watching
rhetoric
this video, and
is
please feel
hopefully
free to
going
visit our
to
website for
return a
additional
little bit softer
resources as
given
well as
what's
information on
happened
the
recently.
upcoming firm events and
But we still
news.
anticipate that volatility is going to be present in the markets up until November. Typically speaking, it happens September, October as we get closer, but it tends to frankly level out after we find out the result of the election. Not because of one party or the other, but just because of the fact that we have certainty and investors can get back to, and allocators of capital, frankly, can get back to just looking at basic fundamental, economic indicators to make investment decisions. So historically speaking, one party has not been more favorable than the other when it comes to results leading out of the election. We continue to expect that to be the case long term, and we'll continue to manage, your investments based off of sound fundamental economic principles, paying more attention to things like economic growth interest rates, inflation, etc. We expect that to be the case moving forward as well. So November will be a big deal, but hopefully not as big as the media is making it out to be. Switching gears to the bond market, this is probably the most optimistic I've been about the bond market in the last couple of years, and Stonebridge's as a whole. The reason is basically because currently we see high coupon rates, we see low default rates, in the bond sector, which is great. And this is going to provide, those high coupons is providing a nice yield on the portfolio right now. Not only is it generating further income for the portfolio and more money in your pocket, but it also will provide a bit more of a buffer if we do see a downturn, right? Given the fact that we're seeing 4 or 5% yields on investment grade corporate bonds, government bonds, etc. So we're excited about that. We think that if there's a rate cut, it should obviously be a boon to existing bond holdings, and we should see some capital appreciation in those bonds, which we haven't been seeing over the last couple of years. So that's exciting, and we're bullish on at least bonds in the short term. One thing we are looking at with the bond market as well is starting to rotate a little bit more out of some of the shorter term bonds that we've been holding, now that we are getting closer to hopefully a rate cutting cycle, and trying to lock in some of those rates for longer terms before the Fed really starts cutting and corporations start following suit. So we're starting to rotate some of our shorter dated bonds into longer term bonds, which should see capital appreciation when we see the rates going down, but then also locking in some of those longer term yields, for clients like yourself. So excited about that. I'm trying to keep it a little bit shorter this time. I can become a little loquacious on these videos, but obviously if anyone has any questions about the markets, the news, how the elections might potentially affect the market, please never hesitate to reach out, shoot me an email, give me a call. More than happy to talk about it. But mostly I just want to continue to thank you for your trust. Look forward to seeing hopefully most of you the second half of the year, certainly talking to all of you in the second half of the year. And I hope you guys have a great rest of the summer. Know we're here if you need us, and take care. Thank you.